What institutional investors don't tell you about buying below appraisal. Buy low, sell high. It's a cliche, sure, but in real estate it's more than good advice. It's a fundamental truth that separates seasoned institutional investors from the rest of the market, and one of their best-kept secrets? Buying below appraisal value. At Venus Venture, we've seen firsthand how acquiring properties below appraised value can be a powerful way to minimize risk, boost returns, and unlock built-in equity from day one. But while institutional investors leverage this strategy often, they rarely talk about it publicly. Here's what they don't tell you, and what you should know. 1. Appraisal is not just a number, it's leverage. An appraisal is an independent valuation of what a property is worth based on current market conditions, recent comps, and income performance. When institutional investors buy below appraisal, they're instantly creating a spread between purchase price and fair market value, and that spread becomes leverage. Example: appraised value, $2 million. Purchase price, $1,650,000. Instant equity, $350,000. That built-in equity strengthens your balance sheet, improves refinance terms, and allows you to negotiate favorable loan-to-value ratios with lenders, all without improving the property yet. 2. It's not always about a distressed deal. Many think buying below appraisal means buying distressed properties or fire sale assets, but that's not always the case. Institutions often find below appraisal deals through off-market transactions, seller motivation, divorce, estate planning, tax deadlines, bulk acquisitions with volume discounts, mismanaged or underleased properties that the appraiser values higher based on potential. It's about information, timing, and negotiation, not desperation. 3. Hidden value, lower risk, higher upside. By purchasing below appraised value, institutional investors reduce their capital at risk. That discount acts as a buffer against market corrections, unforeseen renovation costs, extended lease-up timelines. Even if the market softens slightly, the investment remains insulated. That's why this strategy is favored in uncertain or down-cycle environments, exactly when retail investors tend to get nervous. 4. It supercharges returns. When you buy below appraisal, your return on investment, especially equity, multiple, and IRR, increases significantly. That's because less capital is required to control more value. You're starting with equity instead of building it. Cash-out refinancing or resale provides a faster exit opportunity. Example: if you invest $500,000 into a $2 million property purchased at $1.65 million, and it later sells for its appraised value, without any value-add improvements, you're already realizing a 30% plus gain just by capturing the spread. 5. Most retail investors don't know where to look. Institutional players thrive because they have deal flow relationships with brokers, banks, distressed asset holders, and developers. They don't rely on public listings, and they don't overpay at auctions. At Venus Venture, we replicate this institutional model for our investors. Through private networks and proprietary sourcing methods, we acquire off-market assets consistently below appraisal, then add value through targeted improvements and operational efficiencies. Final thoughts. Buying below appraisal isn't a loophole or a gimmick. It's a disciplined investment strategy. Institutional investors use it to gain instant equity, reduce exposure, and maximize profitability, especially in uncertain markets.